bring in S&P Capital IQ Managing Director and Chief Investment Strategist Sam Stovall. Sam, I always look to you, we always do, for market perspective, historical perspective. How bad is this start to the year? What does it tell us historically, data-driven, what will happen the rest of this year?
Good morning, Dagan. Well, we are certainly starting off with a wake-up call as to the uncertainty from geopolitical events combined with the uncertainty surrounding the economic health, not only here in the U.S. but around the globe. I think that investors, however, should not become their own worst enemies. We have had many times in the past in which the market started on the wrong foot, and we ended up 2 out of every 3 times ending up being positive for January and then positive for the entire year. Obviously, you can say that we have not had a situation in the past similar to what we're experiencing today, except to say that I think fear is what is driving the market's actions right now. We definitely have a risk-off environment right now where people are basically selling first and asking questions later, and I think the magnitude of the futures decline indicates that we are probably approaching a capitulation stage.
Sam, is part of the problem is that nobody saw this coming? That so many of the strategists that you talked to thought, hey, since the S&P was essentially flat last year, what my forecast was for 2015, I'm just going to roll it over a year and say this is what's going to happen in 2016. That's a lot of what I've heard.
Well, you're not wrong. I mean, in some ways, that was my feeling as well, primarily because when you start the year, you realize that 80% of all calendar years since World War II posted a positive total return. So if you're going to think that there's going to be something that's going to be divergent from that, you have to be fairly positive. Also, we've had 10 times since World War II that the market was flat in one year, meaning up or down by less than 3%. And in the subsequent year, the average price change was a gain of 13%, and 80% of the years were positive. Only once did we have a flat year following a flat year. So basically, the probabilities also indicate that you usually have a good year following a ho-hum one.
Sam, given all of that, and given that you said we're looking oversold here, what are you buying here?
Actually, what I'm doing is sitting on my hands right now, but certainly we do have many stocks that are in the buy recommendation. I published a report on Monday entitled The Barbell Portfolio, in which I had looked back over time to say, do you want to buy last year's winners or last year's losers? And history actually says you buy both. So if you're looking at companies that are down or industries that are down 50, 60, 70%, like coal and consumable fuels, you might want to look at a company like Consol Energy, which we have ranked as a strong buy. If you think that oil and gas exploration and production was overdone, then you might want to look to Southwestern Energy, and that too is ranked strong buy. So I would be saying looking for companies that were priced to go out of business, but we don't think will.
Sam, I love how you rattle off the history of it all. It's critical. What do you think about this historical point? Every time, again, unless it's different this time, every single time corporate profits have declined for 2 consecutive quarters, the U.S. stock market has had a 20% or more decline.
That is an interesting statistic, one that I would like to verify myself, but certainly that is a concern. An earnings recession is something that we have been talking about since May of this year. Since World War II, there have been 13 times that we have gone into an earnings recession, and in 10 of those times, it preceded an economic recession. The feeling that this time could be different is that the earnings decline is really the result of the drop-off in the energy earnings. If you take out energy earnings, then the S&P's earnings would be up 6%, not in negative territory, and we're looking for a V-shaped recovery in earnings next year as the decline in energy earnings wanes.
Sam, looking at the market going forward, this hasn't actually been a relatively rational response if you think about it, especially when it comes to the China story. So how do you forecast what the rest of the year looks like if the China situation doesn't turn around? It doesn't show any signs that it will.
Well, that's the big concern that is trying to be evaluated right now. When you look to all of the fundamentals do still point to a solid, not a stupendous, but 2.2% growth in developed GDP, 4% growth in emerging market, 2.7 here in the U.S., looking at about 7.5% earnings growth. Certainly, when you look at a market meltdown globally, you have to ask yourself the question about whether prices are leading fundamentals. Then again, you have to say to yourself, well, the market has anticipated 31 of the last 11 recessions. We've had declines of 10% or more 31 times since World War II, and we've had 11 recessions. So you have a 1 in 3 chance that that is likely to be the next scenario.
And some parts of the market, Sam, are already forecasting that. And I know that, say, small cap stocks, I want to get into this later, small cap stocks are down more than 15% from their peak.
Well, small cap stocks, I think, should be down that much. Right now, they're trading at an 80% premium to the S&P 500's multiple, and historically, they've traded at a 25% premium. So what we find basically is that the small cap stocks, which investors gravitated toward because they thought that with their lack of international exposure in a rising rate environment, which would then put pressure on the dollar, upward pressure on the dollar, the feeling was that, yeah, you want to go to the smaller cap stocks that don't have that kind of exposure, and I think they overdid it. So we still have some more weakness, I think, in the small cap space.
So they're still trading at an 80% premium, even with that sell-off since last June?
We have had, yes, we are looking at right now, an 80% premium to the S&P 500's PE. Also, you're looking at consensus numbers that are expecting S&P small cap earnings to be up more than 50% in 2016 versus this 13% decline we experienced in 2015. So I still think the consensus is way too optimistic.
Sam, thank you so much for all that perspective. Take care of yourself. Sam Stovall joining us from S&P Capital IQ.